From a social security perspective, the question is, what constitutes taxable wages? Taxable wages are wages that are paid to employees by the employers during the calendar year to determine the amount of FICA taxes that are applicable. Recall that wages or compensation can be paid on a variety of bases at a variety of intervals. So you can have hourly wages, salary, piecework rates, bonuses, commissions, the cash value of meals and lodging that are provided for employee convenience, and cash tips. Additional other taxable wages are available here in the next slide. Referencing figure 3.3, several of these examples here are often overlooked by employers, and they're accidentally left out as taxable wages and calculations. Examples that this happens to frequency are fringe benefits like the employee use of a company car, gifts of value, and prizes of value. It's important to remember that these items do constitute taxable wages for legal purposes. I'll leave this up here for just a minute, let you peruse it, although it is included in your book, and it's figure 3.2. Now let's talk a little bit more about tips. So tips are considered taxable compensation, even if they're not a part of the employee's minimum wage calculations. So for example, if a delivery driver makes minimum wage and the employer is participating in a tip credit, the tips that are received are still considered a part of their compensation and thus are taxable wages if they are in excess of $20 per calendar month. Employees are required to report tip amounts to their employers at minimum monthly by the 10th of the month following. The employer must withhold the applicable employee portion of FICA for the tipped amount on the following paycheck and remit the employer portion for FICA on that tipped amount. Employers can claim a credit for the tips in excess of those that were considered to be a part of the employee's minimum wages by filing Form 8846. Now, included as wages, but considered exempt. There are some wages that are specifically defined as non-taxable under the law. These include meals and lodging that are for the convenience of the employer. Sick pay up to 6 months is considered as taxable wages. Once you cross this time threshold, the time off is continuous, the wages become non-taxable. Whether the payment comes from a third-party plan like AFLAC or the employer directly. When a company participates in a qualified deferred compensation retirement plan, the employee wages contributed are taxable for FICA. However, any employer contributions, such as matching contributions, are not. Employer educational assistance has two classes. There's the educational assistance that ties to the employer and the nature of the work completed by the employee. These types of expenses or payments are exempt from FICA. Educational assistance that is provided that is not job-related education is partially exempt from FICA up to $5,250. There are some FICA tax amounts and figures that you need to know. The wage base for OASDI and HI thresholds relate to amounts that are actually paid to the employees in the calendar year and are not in regard to the period in which the service was performed and the wages were earned. These are based on a cash basis, not an accrual basis. The rates for the taxes and the basis can change and have done so over the years. the wage-based changes on the Consumer Price Index. The employee portion of FICA tax is withheld from the employee's paychecks by the employer and is so required to be done so by law. These amounts are required to be reported and remitted to the federal government when the employer reports and remits their own taxes for FICA. For OASDI, the employer and the employee have matching contributions of 6.2% up to $127,200 worth of wages. Therefore, in a calendar year, the max tax for an employee will be $7,886.40. That would be the same amount that the employer would also have as a max. For the HI side, the employer and the employee have matching contributions of 1.45% with no limit to the wages and no maximums. From an employee side only, there's a supplemental HI. There's an additional 0.09% on wages that are over $200,000 in the calendar year. So did you know that in 1950, there were 16 workers paying into Social Security for every one person that was collecting benefits? By 2042, that ratio is projected to be 2 to 1. So we continue to encounter negative population growth. This is going to continue to be a problem. This is where you start hearing all of those alarmist articles and things that you might see on social media or in the news that talks about the negative growth and how this is a bad thing. This is one of the reasons why that is the case. Now, for Social Security, there's some really important numbers that need to be in place. If you are an entity and have employees, every entity that employs one or more person must file for an employer identification number, also called an EIN. This EIN identifies the organization to the IRS in the employment capacity. These can be filed for in a variety of ways and are easy to obtain. There's not a cost associated with filing of the application. This identifying number is used on returns, forms, and correspondence related to the taxes that are imposed under FICA with the IRS and the SSA. This number identifies only this owner, and if the business transfers, the new owner must file for a new EIN. The Social Security Act requires that every employee and self-employed person have a Social Security number. The filing for Social Security number is now generally done in the hospital at the time that a child's born. This was not always the case. In fact, it was in the 1980s when many people received their first Social Security card and were issued their Social Security number due to legislation at that time. Today's day and age of identity theft, it's often the case that you will encounter an individual who has presented a falsified document. The composition of Social Security cards has evolved over the years and now include holograms. Individuals have not been required to get new copies of their Social Security cards, so the older models continue to exist and be presented to employers and are valid Social Security cards. Identifying a falsified document in an older style of the card is very difficult to do. Employers are not expected to be experts in the documents. Therefore, it is suggested that employers use the SSA online system to check names and Social Security numbers. This can be done via screen entry of up to 10 names and Social Security numbers, or through an upload of 250,000 names and numbers with verification occurring the next day. There's some pretty stiff fines that are associated with Social Security card penalties. So somebody is using someone else's Social Security card, they alter a Social Security card, they buy or claim a card to be issued by the secretary that is not so. They possess a card or a counterfeit card with the intent to sell or alter it, or knowingly and willfully use a Social Security number that was obtained with false information. They can be served with up to $5,000 in fines, or 5 years imprisonment, or both. With all taxes, there's going to be some type of an informational return. This is where the employer communicates with the agency regarding the wages and taxes for a specific period. Form 941, Employer's Quarterly Federal Tax Return, is a regular return that you will need to file. You can get the current copy at www.irs.gov, or you can call them. I suggest if you call the IRS, you have plenty of time on your hands. Form 941 is due the last day of the month following the close of the quarter. So generally, that is January 31st, April 30th, July 30th, and October 31st. However, because the calendar does rotate, depending on what day of the week this falls on, if it falls on a legal holiday or a weekend, then it is the next business day. FICA-covered employers are required to withhold the employee portions of FICA on taxable wages and pay the employer portions of FICA taxes on taxable wages and remit the federal withholding taxes. These taxes require either quarterly or annually reporting via Form 941 or 944. Typically, the amounts of taxes that are reported in these reports are electronically transmitted to the IRS. Failure to pay these, make deposits, or file returns can result in penalties, fees, and more frequent filings. There are specialty forms 941s that apply to specific situations, such as for workers in Puerto Rico. These forms will present more of the exception than the rule, but be aware that they do exist. Form 944 applies when an employer owes $1,000 or less annually, and they have made timely deposits of their taxes for the last 2 years. This can also be used by new employers that expect to pay wages of no more than $4,000 per year. The other form you're likely to encounter is Form 945. This is an annual return as well and is used regarding withheld federal income tax from non-payroll items such as pensions and IRAs. An employer's depositing frequency is based on the notification they receive each November. This notice utilizes the look-back period of 4 quarters beginning July 1st of the second preceding year and ending June 30th of the prior year. The 2018 look-back period is third and fourth quarters for 2016 and first and second quarters for 2017. During this look-back period, there's an evaluation of the federal income tax and FICA taxes, and based on stated amounts, require filing at a specific frequency. Brand new employers are deemed monthly depositors initially, unless there's an event that triggers the one-day rule, at which time the new employer then moves to a semi-weekly depositor. The depositing frequency in regards to agricultural employees and household employees differ. I'm sure that you've noticed that it's often the case that there are special rules that apply to these two types of employees. FICA and federal income tax are always deposited together. The depositing frequency and the dates of the deposits depend upon that depositing frequency. So if you are a monthly depositor, then it must be deposited by the 15th of the following month. If you are a semi-weekly, if the payday is Wednesday, Thursday, or Friday, you have until the following Wednesday. If the payday is Saturday, Sunday, or Monday, you have until the following Friday. The one-day rule is something that will happen less often than you can imagine. If there is $100,000 or more in federal tax liability, then you must deposit it by close of the next business day. There is no deposits if there is less than $2,500 for the whole quarter. And new employers are by definition monthly depositors until they reach a look-back period to ascertain differently. This slide gives you a quick representation of the different rules and how we deal with whether or not somebody's a monthly depositor, a semi-weekly depositor, they fall into the one-day rule, or they have no deposits. This chart is also found in your book. The EFTPS system is a communication network that allows for the direct transfer of funds from the employer's financial institution to the Treasury Department. It removes the potential errors and delays that may occur in the older system, such as the U.S. Postal Service issues. These transfers can be initiated in a number of ways. Through a touch-tone phone, there's software transmittal, and then there is online at the www.eftps.gov. Employers are not tied to one electronic method, and they can easily switch between them. Generally, all employers are required to deposit electronically. The exception to this is when a business owes $2,500 or less in quarterly tax liabilities. Now, through quarterly reporting, we have the Form 941. Generally, the form is self-explanatory, and the various sources of info are easily available to the payroll professional. Please note there are a few key things that are important when populating the report. Dollar signs and decimal points are not used. Zero value line items you leave blank. You do not populate a zero. Negative amounts use a minus sign. And there is no rounding to the nearest dollar in this case. Actually use the cents. Additional considerations include credits, sick pay, adjustments, tips. And due to rounding, there may be some fractions of cents on the employee's share of amounts of what is actually withheld. We will go over a Form 941 in class and potentially have an additional video that will go over it as well. So some sources of information for the 941. You'll recall the payroll register, the general ledger account for wages and salaries, general ledger balances, Forms 4070 or written statements regarding cash tips, notice that the payroll register is referenced time and time again. The payroll register is your friend. Each of these discusses how to handle a specific line on the 941. The Form 941 must be signed by one of the designated individuals based on the entity formation. If it is an individual, the return should be signed by that person. If it's a corporation, the return should be signed by its president, vice president, or other principal officer that is authorized to sign the return. Corporate officers or duly authorized agents may use facsimile signatures underneath certain circumstances. If it is a partnership or an other unincorporated organization, a responsible and duly authorized partner or officer having knowledge of the firm's affairs should sign the return. If it is a trust, the return should be signed by the fiduciary of the trust or the estate. If it is a political body, such as a state or territory, the return should be signed by the officer or employee having control of the wage payments or the officer properly designated for that purpose. An agent who pays the wages for the employer may be authorized by the employer to sign the appropriate tax returns. Employment tax forms can be signed by a facsimile rubber stamp, mechanical device, or computer software program. Employers can use credit cards to pay the balance due as shown on Form 941. This does not apply to tax deposits. You must file your Form 941 by the last day of the month following the applicable calendar quarter to generally be considered timely. This timeline is extended to the 10th of the second month for employers that made timely deposits for that quarter. Remember, the deposits, the remitting of the money is one thing. The filing of the form is another. If for some reason you have to complete a hard copy and mail the form, you must send it via method that the return will reach the applicable IRS center no later than the next business day under normal handling of the mail. Once an employer has filed their initial Form 941, they must file a Form 941, even in the event that there are no taxes to report in a quarter. This is called a zero filing. There are multiple desktop and online filing options to file a 941 electronically. It's encouraged that businesses file electronically rather than good old-fashioned hard copy. In the event that there is an error on a prior 941, because really, hey, no one's perfect, a Form 941X is filed and is a standalone form and not attached to a 941. If you fail to comply, there are a variety of penalties that may be imposed. The monetary and criminal penalties vary according to the type of failure to comply. Some of the less significant failure to comply penalties, such as failure to file employment tax returns timely, where the employer can prove that it was due to a reasonable cause and not willful conduct, can have monetary penalties potentially waived. Remember, the burden of proof would lie with the employer and not the IRS. The severity of the penalties range from additional tax, interest charges, or tax levies to steep fines and potential imprisonment. Some of the failure to penalties include not filing employment tax returns on time, not paying full taxes when due, not making timely deposits, not furnishing W-2s to employees on a timely basis, not filing information returns with the IRS on time, not supplying identification numbers, or writing a bad check.